Welcome to our summary of what the Fed's been doing and its rate decision, or indecision as it turned out, and what are the reasons behind it. And also, I think this was a politically sensitive Fed meeting, and so it's worthwhile talking about the background to this and also the statement which Powell made on the 11th of January, which I'll come back to. So let me just double check that the audio is working. Normally Sam tells me. So Laura is away, I should say. She's in Thailand. Usually she runs things behind the scenes. Sam, our wonderful community manager, is running things tonight. Thank you, Sam. So she stayed up late at night, especially for this. So that's what's going on in the background. I'll do a quick summary of what the Fed said, the reasons behind it. I'll go through what was said in the press conference. We might look at some of the data, if it just helps with the argument and talks about what and kind of amplifies what the Fed has done. And then you can ask me questions. Now, normally what happens is between my summary and your questions, Ted runs up here. Laura lets him out of the office downstairs. You hear the thundering of paws up the stairs. I give him a bit of these treats, and then he dashes back downstairs to get Biltong. Well, there's no Biltong, so he's not going to be happy, and he'll probably hang out here and bother me. So if you see a cockapoo savaging a YouTuber, that's probably why. Anyway, let's get started with the overall summary. As far as I can tell, nobody's complained about the volume so far, but yeah, hopefully it should all work good. So let's start with the decision. Now, there was dissent. So two members of the committee decided that they didn't want to keep rates where they are. Two members, of course, included Stephen Moran, and Waller was the other one. And there's an interesting consequence of that as well, which we'll see in a moment. But that was the decision. Don't do anything. Keep rates where they are now, which is in the 3.5 to 3.75% range for Fed funds. And really, I'd say that the message was that they've already had 3 rate cuts and they've cut by 75 basis points, and policy now is in a reasonable place to stay and watch the data. And it was pretty clear during the press conference that Powell didn't think it was job done. Trump has actually come out and said, we've killed inflation. Well, actually, no, they haven't. And the reason for that is that a large part of the tariff cost has been borne by companies who stand between consumers and the taxes which have been imposed. In other words, those importing companies have paid it out of their margins. However, they've made it very clear to the Fed that they are going to pass it on to their consumers. And that means that we haven't seen the full effects of the tariff so far. And in fact, the Fed has been monitoring it tariff by tariff. And a big reason that the impact hasn't been as large as expected was that the actual tariffs in practice were much smaller in scope than the ones which were announced in April of 2025, which caused the big sell-off. So smaller in scope, no counter tariffs of note, although China was probably one of them, but broad-based, there wasn't a lot of pushback as there were with the Smoot-Hawley Act a century ago. And anyway, we'll come back to that probably. But as always, Powell said there's no preset path, so there's no promise of rate cuts again in future. But there's no eagerness to hike either. So really this is a pause, not a move to higher rates. It's just wait and see with a reasonably restrictive or not particularly restrictive monetary policy. Now, the overall summary, I'd say, of the economic condition, which is always really worth listening to, because it's written by an army of really capable economists at the Fed. It looked pretty upbeat. And in fact, growth is on a really strong footing, kind of as you'd expect, given the size of the fiscal deficit, which is 6%, which is kind of wartime deficits, is what you'd expect, 6% of GDP, even though growth is strong and inflation is sticky higher than expected or higher than hoped. So that's obviously going to stimulate the economy, and consumer spending has been pretty resilient, and business investment has expanded. Largely, it has to be said, in AI infrastructure, but also elsewhere. Housing still remains weak, so it's not an overall peachy picture. And there was a one-off factor in this data set that we've just seen due to this temporary federal government shutdown. So that probably weighed on growth in the last quarter, but that should reverse as the reopening boosts activity in this quarter. So it actually just took some growth from the previous quarter, picked it up and plonked it into this quarter. And so, of course, the Fed's aware of that and it'll adjust for it. But it does mean the recent data is quite distorted. Then we look at the labour market. Now, that's the thing which, remember, caused all the anger from Trump, because that seems to be weakening. However, Powell says that it may be stabilising now after a gradual softening period. But it is uncertain. These labour surveys are now difficult to read because remember that the responses to the survey have dropped, and that means that the data may not be as reliable as it was in the past. And of course, if Trump sees a number he doesn't like, he tends to fire the head of the statistical agency. I don't know if that affects their decisions about what they publish, but in fact, the non-farm payrolls numbers haven't been that great. In fact, why don't we have a quick look at that, just quickly, because I think that is interesting. Let me just pull up the non-farm payrolls. Can I? Yes, I can. Here we go. And share with you. There we have it. Now, you can see if we zoom in on the latest data, oh, we've got this funny plugin. Let me just switch that off and I'll go back to you. One sec. Okay, that's not going to work. Okay, we're not going to look at that. But the point was that we have seen a weakening of the US jobs market, and jobs growth is pretty weak. And if you look at the number of new jobs which have been added to the US jobs market, it's not huge. So in the last two prints, we've seen 56,000 and 50,000 new jobs added to the US labour market, which is roughly in line with what you'd need to absorb new entrants to the jobs market. And 3 months ago, we had a huge negative print, but that again was distorted data. So non-farm payrolls has declined on average over the last 3 months, and even private payrolls have only modestly grown. So what's weird is that unemployment hasn't risen faster, but the point Powell makes is that labour supply growth has also slowed, and that's presumably because of lower immigration, because one of the big Trump policies, and one of the controversial ones, of course, at the moment, is about cutting immigration. And also, it's to do with changes in the participation rate, which is the number of people who could work, who do work. So fewer new workers are coming in, and that makes the jobs numbers look less bad than they would otherwise. But there are other indicators that you can look at, like openings, layoffs, hiring, wage growth. All of those haven't shown really dramatic changes recently. Now, he actually went further than that, and he said this is a weird labour market to read because supply and demand for labour have both slowed at the same time. So if both slow enough, of course, you can end up with low jobs growth, but they'd still be in balance. So he keeps saying they're data dependent and also cautious about really strong claims about things being inflationary or deflationary. But if you look at inflation, yes, it's way down from the highs, but it is stuck above target. So if you look at total PCE inflation, that's the personal consumption expenditures inflation, that's around 2.9%. And the one that the Fed focuses on, where you strip out the volatile elements, that's around 3%. So their target's 2%, and so that's still a way above where they wanted to be. And according to Powell, a big reason for that, or a big driver of that, is about goods inflation. Remember, what happened was that we had goods deflation for a while, and it was services that were driving up inflation. Well, that's not true anymore, and that's because of tariffs. Now, obviously, that's going to cause contention in the White House, because a lot of people in the White House and the administration have said that tariffs aren't inflationary. Well, of course they are, but it's a question of whether those price increases are sticky. So is it just going to roll out of the 12-month window and then not have any effect after that? Of course, the level of prices will be higher then, but the year-on-year change, which is what inflation is usually measured by, will subside if that's the case. If expectations of inflation get anchored higher by higher prices, then it could become sticky. But what it looks like right now is that services are gradually cooling, tariffs are still pushing goods prices up, and it sounds like a lot of that is going to carry on happening because the man in the middle, which is the companies, are going to start passing that onto their customers and to the general consumption basket by increasing their prices. So if inflation is demand driven, what would you do if you're the Fed? Well, of course, you tighten policy. If it's a one-off price shock, you can just look through it. So it's really important that the Fed works out whether inflation expectations are going to stay anchored. If they are, then they can't look through it, and they'll have to keep rates higher for longer. But broadly at the moment, it looks like inflation expectations are consistent with 2% in the longer term. So why did they hold rates today? Obviously, that was the big question. Well, to just kind of boil it down to some bullet points, I think that the way Powell sees it is they've already cut a lot. They're now closer to the neutral rate. Nobody really knows what it is, but if you look at the dot plots, we're not too far from it. Now that's the rate which is neither stimulating or slowing down the economy. It's a kind of invisible, difficult to assess target, but many people now think we are at neutral. And the economy is growing at a pretty good pace, so it isn't the case that the rate at the moment is dampening growth. Far from it. It seems as if growth is pretty strong in the US. And inflation, on the other hand, is still above target. So there's still this contention in the Fed's two goals. Of course, they want to keep prices stable, but they don't want to crush the economy. And so that's pulling the policy rate choices in those two different directions. But what's good is that the labour market isn't collapsing. And in fact, it looks like it's now stabilising. There were worries that it was collapsing, but that doesn't seem to be the case. An interesting thing that Powell said is if you look at growth and you look at the labour market in the US, and they're telling you different signals, the one that usually wins is the jobs market. And that's because GDP is so difficult to measure. It often comes with a big lag as well, whereas jobs are easier, still difficult, of course, to measure. And of course, they're looking at the balance of risk between their two targets. But certainly at the moment, they think those two risks of crushing the economy and letting inflation jump up again are fairly well balanced, certainly based on the incoming data recently. And if we look at the future cuts, the Fed really needs evidence that inflation is cooling again in order for that to happen, or that the labour market is weakening quite meaningfully. And neither of those is true at the moment. Inflation is still quite sticky, and the jobs market is actually stabilising now. So that's not going to be good news if you're President Trump, who wants rates to be cut, of course. Now, fast forward to the questions from the journalists. That was really interesting because they kept asking about the subpoenas. Remember, what happened was that the testimony that Powell gave to Congress about the refurbishments on the buildings for the Federal Reserve, those have run over budget significantly. And now the Justice Justice Department has actually landed subpoenas on the Federal Reserve, and he didn't talk about that at all. He said, just refer back to my statement of January the 11th. Now, if you haven't watched that, I've actually put it onto my Blue Sky feed, and I've actually annotated the video. So just look at PensionCraft on Blue Sky and you'll see the whole thing. It's 2 minutes of your time. It's well worth watching. And just listen to what Powell said. Essentially, he said it's a pretext. This is just a pretext because we didn't cut rates. We put rates where we thought they should be based on economic data, which meant we didn't cut fast enough for the president. And that's why these subpoenas have landed in the Fed's inbox. But anyway, he wouldn't talk about the subpoenas. He said, just look at the January the 11th video, which I posted, which you should do too. And they asked about whether he'd remain as a governor. No answer. They asked about what a transition to the new chair might look like. No answer. And he also wouldn't talk about senators blocking nominees, because one of the senators has actually said that he won't approve a new Fed chair unless this stuff about the subpoenas gets sorted. But there was something which actually triggered him, and it was actually when one of the journalists asked, what happens if the Fed loses independence? And here the answer was pretty strong. He says that independence isn't about protecting policymakers. It's an institutional arrangement used across advanced democracies to avoid monetary policy being used for election cycle politics. Of course, politicians want low interest rates. They want a hot economy, and screw inflation. Who cares? I'll get re-elected. They don't really care, because initially what happens is more employment, more wealth for the country. Of course, politicians want that because it's popular. And a populist politician, that's like, the best possible rush and the best possible outcome. But what happens, as we've seen time and time again in the past, is that triggers inflation. And then in the end, the Fed would have to hike aggressively in order to stave off inflation, and that causes a recession. And we've seen that cycle so many times. And yet, if we don't have an independent Fed, then that's what happens. The Fed isn't going to raise rates when it should. It's going to cut rates aggressively, throw fuel on the fire, and the economy overheats, and we get inflation, runaway inflation potentially. But over the short term, great, good for politicians, they get it re-elected, but eventually you have to pay the price. But Powell made the point that if people stop believing that the Fed's making decisions for the public interest, then it's going to get really difficult for the Fed to maintain credibility. And once you've lost credibility, it's so hard to restore it. Just look at the Turkish central bank and what happened to inflation when the president decided to take over policy and come up with something unconventional, which was when inflation was really high, he decided that low interest rates were a good idea. If that sounds familiar, well, it probably is. So anyway, Powell is strongly committed to independence. That's pretty clear. And his colleagues are too. And that's why. Because you act in the best interest of the economy, even if that's difficult medicine to take. So, yeah, obviously, Powell cares about independence, and that certainly got a response out of him when he wouldn't talk about all of those other questions. Now, several journalists said to him, what's the test in order to cut further? Now, he didn't give just one trigger, but of course he didn't, because it is a multi-dimensional problem. But what he did was lay out the logic. Now, if he sees that tariffs, the inflation tariff, or the tariff-driven inflation starts to peak, because remember, they are tracing this item by item to see what the effect of the tariffs is. Once they see that inflation effect peaks and it starts to come down, then that could be the point at which they start easing. But they're not going to do that until that happens. If the labour market stops stabilising and you start to see downside risks to employment, then that could also make them cut. And of course, they have a two-sided mandate. So it's always about balancing the risk of crushing growth and allowing inflation to run rampant. But anyway, the base case right now, amongst all of the members of the committee, apparently, including Moran, is that a rate hike isn't the base case, right? So they're not talking about hiking now, increasing interest rates, but everything remains possible and it's data dependent. That's what he always says. So if inflation re-accelerated, of course, then they could hike, but that's not what they expect. Dollar, everyone's been talking about dollar weakness, and there were rumours today that the dollar was actually affected by intervention by the government, which hasn't happened in 30 years, when the US government actually tried to buy dollars in order to stabilise the currency. Well, apparently that wasn't what the Treasury did. And of course, that's the Treasury's bailiwick, as Powell described it. It's not to do with the Fed. So he said, if you want to ask about that, ask the US Treasury. And of course, it's Scott Bessent who you'd ask. And of course, Bessent denied that they'd intervened. So Powell shut that one down. He said they don't comment on the dollar. So he won't talk about that. He talks about pass-through inflation, of course, because that affects monetary policy, but not the weakness of the dollar and the reasons behind it. He didn't discuss that, and he said he wouldn't. What else interesting? There was mention of AI. It seems to happen at every press conference now. And he said that every tech wave disrupts jobs and raises productivity. And what we have seen in the US, but not in the UK, is pretty strong productivity growth, presumably down to AI. People can produce more services, I assume, because of the increased productivity due to AI. So last year, over 2025, I think productivity rose between 2 and 5% in the US. In the UK, it was stagnant. But he did say that things like short-term job displacement is difficult to measure. But of course, it does affect US policy. They're certainly aware of it. But there is no policy response to it yet, the effect of AI on the jobs market and productivity. So the Fed's on hold. We've had 3 rate cuts, and they think policy is neutral-ish. Inflation's still stuck around the 3% for core PCE inflation, which is the one they focus on. The Fed is blaming a lot of that on tariffs in goods rather than services. Services inflation is improving, so that's good news. That's good news for everyone. And the labour market is weak in job creation terms. So this is what they call a jobless recovery, unfortunately. But unemployment isn't surging, which is good news. But largely that's because labour supply growth has slowed, which is possibly due to immigration falling. So the next move is probably down. But of course, when you're near to the neutral rate, it could go either way. But the Fed really wants to look at that evidence and be absolutely sure that we're not going to see the effect of tariffs delayed, pushing up inflation later, and then they've already cut and they have to reverse course very quickly. That would be awful. So they're not pre-committing to any kind of future moves. Now, what's really important is that the Fed remains independent and it remains credible. And that's a really important theme for Powell and the Fed, and it should always be an important theme. It's not just some kind of academic thing, and you should really watch that video that Powell did on January the 11th. So, Fed's not panicking, it's not rushing, it's not declaring victory on inflation, although it has to be said, it has managed a soft landing. People were talking about this for so long. Well, this is it. We've got the soft landing. Not the wheels aren't quite on the ground yet. So don't declare victory, but we're not far off. So the easy part is done. We've got to wait for the data to confirm whether tariffs fade as a one-off year-on-year change, but also whether the jobs market is going to stabilize in the US. So that's my summary. Hopefully that was fairly succinct. I don't know how long that took. It took quite a while. Okay, I'm sorry. Anyway, that's the take. And normally now, right, I'd kind of pull Teddy up here, and then he'd kind of mug me. But I guess that's not going to happen because he's actually, I think he's asleep. I don't know where he's under the desk. Oh, you've woken up now. So I will summon my cockapoo and give him a treat because he's a very good boy. And then you can think of some questions and we'll have a quick Q&A before I pass out. Brilliant. Let me just summon the cockapoo. Do you want a treat, Ted? Oh yeah. I'm not disturbing you, am I? I think I probably was. Gonna jump up. Gonna jump up. Oh no. Getting in position. No. No. Here he comes. He expects it to drop into his mouth. You've got to come around here, mate. People have got to see you. Oh, good boy. One more. One more. Very good. Good lad. He's a good boy. Brilliant. So there we go. There's no bill tongue, I'm afraid, because Laura's not here. I know. Okay, so now we've got your question. So please do ask a question. Super chat gets pushed to the front of the queue, so please do super chat. And Sam will be aggregating your super chats into a document, which I think I've lost. So let me just pull up that document. Anything you like about investment, it could be the Fed. Tell me what you think about what they've done, but also about Fed independence, because I think that's really important. Certainly from the Fed's point of view, but for any central bank. But we have seen some shocking things, and trying to fire Lisa Cook, for example. One of the interesting things was that one of the questions to Powell was, why did you go to the court case? Why did you attend court when Lisa Cook was in court? And he said, I thought about it and I realized that what if I didn't go? And he said there was a precedent for this, which is Volcker, the previous very famous Fed chair, also attended one of these court cases, presumably for one of the Fed employees. Maybe, I don't know. I don't know what the precedent was, but he said that he felt he had to go, and it was a really unusual thing for the Trump administration to try and press charges against one of the FOMC board members. Based on, I think it was some kind of mortgage application or a mortgage which she didn't pay the right tax for, something like that. But again, it seems like a pretext in order to reduce the number of independent Fed board members, and to appoint new board members who are more likely to cut interest rates. And of course, that erodes the credibility of the Fed, which nobody wants to see. Okay, so Sam says the volume's all good. That's excellent. And what else have we got? Let me pull up the document. So, do we have any questions? Sam's typing. I can look at the questions. Let me put the lid back on the treat box, otherwise we'll be in trouble. Right, let's see what we've got. Hello from Belfast. Hello. Joe Montague, 5185. AV is all good, sounds good. What else? So I was hoping I could show you these slides, but they're still dark. That's not good. Dark. Light? No. On, light. Let me just try one refresh and see if that fixes it. Yes, it does. Marvellous. I found this plugin which kind of puts things in dark mode, but unfortunately it affected everything. So that wasn't great. Right. Yeah, let me just show you the non-farm payrolls because that's pretty shocking. This is what it looks like right now. So the dashed line you can see is how many jobs you need to generate just to absorb new entrants to the jobs market. So if you're above that, the number of people who are employed will increase. If you're below that, it decreases. So you can see it has been weak. We have these very weak prints, 56 and 50. But maybe that's due to immigration and the new dynamics between inflation and between demand for jobs, demand for workers and supply of workers. Both have fallen. And here's the thing about Trump firing the US Labour Statistics boss. That was Erica McIntyre. It was another thing I wanted to show you. That's core PC, and you can see that it is quite sticky. So core PC is 2.8, which is quite a long way above the 2 target. Yeah, growth pretty good. 4.4 was the latest print. The balance sheet, you can see a little kink here because remember what they've done is they've stopped, I think they've stopped shrinking the balance sheet now. And this was the expectations going into today's meeting. So I always take a picture of this. I do it at every meeting. And you can see how the dashed line, by the way, is when Powell's tenure ends as Fed chair. And you can see the first rate cut is now the first meeting after Powell leaves, which is in June the 17th, 2026 this year. So that's when the first cut is expected. And then we pretty much stick at that 300 to 325 basis point Fed funds rate. And the first hike, according to this, is in 2027 in August. But, you know, the data is quite wishy-washy. The probabilities are quite dispersed at that point. So that's what the futures market, the Fed futures market, is telling us right now. Yeah. So back to you. And back to the questions. What else have we got? We're complaining about the lack of Teddy. That's Rajasilan Ganeswaran, who I can finally pronounce the name of. I've had good practice. Nice to see you, Rajasilan. Here we go. Srinivasan Palani, 6908. Srinivasan, am I saying that correctly? Palani, 6908, says, is it good for investors to invest in the US due to ongoing Trump admin's issue against all countries and great US sell-off? Interesting question. Many people had been talking about divesting from US assets. Even the CIO of PIMCO, the huge US bond manager, although they manage equity as well, and known for bonds, he said that the unstable policy decisions coming out of the White House make it very difficult to invest in the US. And he makes the point about trying to push down interest rates even when it's not appropriate, which makes problems down the line from overheated economies. So what he actually said, Dan Iverson, was that that PIMCO is gradually allocating away from the US. Now, many of the people I speak to talk about that. And I'm always cautious because I always say betting against the US is a bit of a widow-maker trade, certainly in equities. When it comes to bonds, I think that's more interesting because as a UK investor, I don't have any US treasuries. All of my safety money is either in UK money market funds or in gilts. And at the moment, I don't hold any gilts. I have in the past, but it's all in money market funds, which are sterling denominated short-dated paper. No treasuries, no global bond fund. And that's, I think, because of the fundamentals of the UK economy being strong. You know, the UK, in terms of the bond market, looks a lot better, I think, than the US right now. You know, various things cause that. Central bank independence is one of them. Anyway, I've got a video coming out soon. I think it's this Saturday, which is all about why I don't own US treasuries. I think it's called US Treasury Trap, which always sounds exciting. But anyway, that's the title of the video probably. But do have a watch of that, because there I kind of lay out the reasons why I think for UK investors, treasuries might not make sense. Cutting back on US equity is another matter altogether. I think that US equity probably will be okay. In fact, if inflation is allowed to run hot and the economies run hot, which is clearly what Trump is doing, he wants to go out on a real high. Over the next 2 or 3 years, we've got fiscal stimulus, we've got now a Fed which is neither, you couldn't describe monetary policy right now as being restrictive, I don't think. It's kind of close to neutral. So lowish interest rates, huge fiscal deficit of 6%, big fiscal stimulus from Trump. So I think that's a pretty good backdrop for the US equity market, unless we have some kind of accident. And of course, another part of the policies is about deregulation, it's about tariffs. So there's lots of scope for an accident, I think. But the base case, I'd say, is that the US equity market looks pretty strong. And if you look at valuations, there's only one stock which is crazy amongst the Mag 7, and that's Tesla. That's trading at 200 times forward earnings, whereas the rest of the Mag 7 are much more reasonably priced. I mean, I can see if I can find the Ardani graph, which has got that. Because people often say, oh, look, the American stocks are so expensive, I'm nervous about investing because of that. Well, in fact, it's not as bad as you think. Oh, it's still dark. This is really annoying me. There we go. Let's go down to this. I'm about to share. Don't panic. There we go. So let's maximize that. So these are the individual forward price to earnings multiples for the Mag 8 in this case. So there's an extra one here which is probably Netflix. But anyway, this is the Mag 8, and look, there's one that's gone off the top of the graph. So currently Tesla's forward price to earnings multiple is 202. So crazy multiple. But of course, that's what it's been flickering up and down to for a while now. Whereas if you look at the Mag 7, excluding Tesla, what you can see is that their multiples are actually high, but not crazy. So Apple's 30, but Meta's 22, Nvidia 24, Alphabet 29, Amazon 30. So not absolutely crazy. High, yeah, but not crazy. So I think, the arguments for staying in US equity are pretty strong. I wouldn't divest of US equity. If you are going to do that, maybe rotate to value. Don't do anything crazy, but don't do it lock, stock and barrel. Keep your core allocation heavily market cap weighted. Maybe tilt to small caps because those are what's done well. So let's have a quick look at recent returns, because I think that's interesting too. We have seen a big rotation in US stocks over the course of this year. Let me just pull that up. Dark, light, here we go. And trackers. So this is what you get if you're one of our premium website members. The colours have gone funny, I'm sorry for that. And this is what I was going to show you, the index heat maps. So this is what's happened to the S&P 500 over the last week. These are returns over the last trading week anyway, up to yesterday's close. And it's pretty green. The Mag 7 is looking pretty green. It was a sea of red previously. But if we have a look at the factors, and if we look over the last month, say, and we, instead of looking at indices, we look at factors. So these are individual ETFs in the US, which give you exposure to every combination, right? So it's small cap, mid cap, large cap versus value, growth, and core, right? So think of it like a 3x3 grid wrapped out as a series of bar plots showing the returns over the last month. And look what's at the top of the table. It's small cap value, the thing which worked for so long and which is finally starting to work again. And if we look at large caps, large cap growth, which is the Mag 7, that's only up just under 1% over the last month, whereas small cap value up 6.5. So, all these people that said, oh, the rotation to value is finally going to happen, well, it looks like it is happening. Even if we look over the last 3 months, it's small cap value which comes out top. And if we look at large cap growth, it's flat. So that's 3 months. If we look at 6 months, well, now small cap value is still top. But I think here, growth is low down on the table. But where's large cap growth? Here we go. It's starting to creep up, 10.1. And over the last year, it's about large cap growth. So we go back to that long-term trend over that 10-year period when large cap growth has done best and value's kind of floundering. But actually, over the recent periods, that rotation's been pretty noticeable. And the other rotation which we've seen is if we look internationally. So if we look at country ETFs over the last 3 months, say, where's the US? Well, it's right down at the bottom of the table, 1.5%. And, go Paddington. Peru is top of the table. Yes. Okay. I'm not sure what's fueling Paddington. There are rumours. So 6 months, Peru's still top. 1 year, and still top. So, go Peru. Anyway, so that's what markets look like right now. Big rotation. Interesting. When this... Oh, Ted, I'm sorry. Oh, I crushed my dog. Oh, Ted, I'm sorry you were under the desk. Maybe I should give you a treat. What do you think? Probably. I just trod on my dog. I got excited about Peru. Go on then. Now one more treat. Good lad. There's no Laura. Sorry. No Biltong. Anyway, let me go back to your document, see if any super chats. No, we don't have any. Who else have we got? Let's see if I can find that Powell thing as well. That might be a good place to end, actually, because Powell had this really powerful speech on dark light. Is it working? Let me refresh. There we go. Hopefully you can see that. So yeah, this is the Powell speech. I wonder if we can listen to it. It's only 2 minutes.
On Friday, Good evening. On Friday, the Department of Justice served the Federal Reserve with grand jury subpoenas, threatening a criminal indictment related to my testimony before the Senate Banking Committee last June. That testimony concerned in part a multi-year project to renovate historic Federal Reserve office buildings. I have deep respect for the rule of law and for accountability in our democracy. No one, certainly not the chair of the Federal Reserve, is above the law. But this unprecedented action should be seen in the broader context of the administration's threats and ongoing pressure. This new threat is not about my testimony last June or about the renovation of the Federal Reserve buildings. It is not about Congress's oversight role. The Fed, through testimony and other public disclosures, made every effort to keep Congress informed about the renovation project. Those are pretexts. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president. This is about whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, or whether instead monetary policy will be directed by political pressure or intimidation. I have served at the Federal Reserve under 4 administrations, Republicans and Democrats alike. In every case, I have carried out my duties without political fear or favor, focused solely on our mandate of price stability and maximum employment. Public service sometimes requires standing firm in the face of threats. I will continue to do the job the Senate confirmed me to do, with integrity and a commitment to serving the American people. Thank you.
There we go. Shocking, I think. But interesting, right? That the Federal Reserve Chair has to come out and say that. We certainly live in interesting times. Anyway, look, thank you for joining us. If you did ask a question as a super chat, I certainly didn't see it. I can have a quick scoot through. No, I can't see any. Anyway, we will be doing this again for the Bank of England. Let me just double check when that's going to happen. I think it's next week. It's usually 1 week away. Yeah, so it's going to be on Thursday the 5th. And that happens at a much more reasonable time of 6 o'clock in the evening. So, yeah, join us for that. And remember that we do have a community. You can join our community. Just go to pensioncraft.com/membership to learn more. I do one-to-one coaching. So just go to pensioncraft.com/coaching to book a one-to-one session with me, to discuss your finances, to bounce ideas off me, to show me your portfolio, anything you want really. On that page, the coaching page, you'll see what I offer, which is guidance, education, coaching, not advice, of course. And anyway, thank you for joining us, and hopefully good luck with your portfolios, right?